main point of our paper is identifying the neighborhood characteristics that drive banking access. So the number of banks within a certain driving distance of a neighborhood, as well as banking deserts, which are neighborhoods that fail to meet a given threshold for the number of banks within a given driving distance. So we take a look at how certain characteristics, such as income or small business lending, so that might be more associated with profit, as well as others that might be more associated with discrimination, such as proportion of African American residents or Hispanic residents, how those impact banking access and banking desert formation. In this paper, we start with the bank branch location of each bank branch in North Carolina. We then assign each bank branch a census tract. So we use some GIS software to identify the number of bank branches within a given driving distance of a census tract centroid within North Carolina. We count that up. Then we take, then we're able to calculate first the banking access, so the number of bank branches on a per capita basis for each census tract. We're then able to identify if a bank branch qualifies as a banking desert if it doesn't meet a minimum threshold of number of bank branches. And we do that over time. So we have a panel data set of the number of bank branches per person at the census tract level over a period of time. We then pull in and attach socioeconomic, demographic characteristics of each census tract. We're also able to pull in characteristics such as small business lending at the census tract level. So in sum, we end up with a panel data set, a data set over time at a census tract year level that gives us the number of bank branches on a per capita basis. Also, if it meets a certain threshold of number of bank branches, as well as a series of characteristics, some that are more perhaps profit driven, we might think of as more profit driven, as well as some that are more associated with discrimination. So race, ethnicity, the proportion of African American residents, Hispanic residents. And we use a series of regression techniques using both a cross-section and a panel data set to identify what are the characteristics that are driving banking access within a neighborhood, as well as bank desert formation. And through this, we're able to see that we're finding evidence consistent with both more of a profit-driven motive. So we're seeing that banking access is driven by things like income, population density, competition, small business lending, but we're also seeing some evidence consistent with areas with a higher proportion of Hispanic residents, for example, having a lower number of bank branches on a per capita basis. And so we're really able to take a deep dive into what are the different characteristics that are driving banking access within a community. Our policy recommendations are really born out of the concern that when you lose access to a physical bank branch, you may also be losing access to credit from a small business and home perspective. And so this may have an adverse impact on economic development within a community. And so some of the policy recommendations that come out of this are one could directly subsidize existing bank branches or subsidize the building of additional bank branches. One could also identify government programs or public policies that would mitigate the negative effects of losing access to a bank branch. Finally, in the background here is the trend towards online banking. And so one of the policy implications may be to identify what are the pros of online banking, what are the cons of online banking, what's lost when a customer shifts from an in-person bank to an online bank, and then identifying what are ways that perhaps policymakers could work with banks in order to identify ways to ensure that economic development piece is not lost when banks move online.